Well, what is happening here is that the market is realizing that the Federal Reserve, like the ECB, for example, they have their hands tight. They are going towards last quarter of the year where the economy is going to stagnate, and there is the risk that inflation is going to peak higher. However, we have received strong economic data from the US, and that put the basis on bond investors to see yields slightly higher than what we have seen until now. So just to better understand what we are going towards and what are pushing yields higher, we have to understand that in a stagflationary kind of environment, the Federal Reserve will not be able to hike because otherwise will put the economy in jeopardy, but it will not be able to cut interest rates either because otherwise it will put pressure on interest rates. So there it comes in the message that policymakers have been trying to convey until now, that they will need to keep rates higher for longer. And what does that mean? It means that front-term yields are going to be more or less anchored where they are now, but long-term yields are free to rise slightly and then to trade range-bound somewhat higher until the cutting cycle begins. We believe that 10 years yields are very likely to rise to 4.5% and 30-year U.S. Treasury yields to rise to 4.75%.
Okay, interesting. So you're bearish, I would say, on the outlook for yields looking ahead. What do you think positioning is like? I've spoken to a lot of people, again, the last couple of weeks, and many seem to think that steepeners are the way to go here for fixed income.
We believe so too, and the great things about steepeners is that you don't really care if it's bearish or bullish steepeners, as long as that is your trade. But we also favor other kind of products. In a stagflationary kind of environment, we really like inflation-protected securities, so TIPS, and the reason for that is that they will gain as the Federal Reserve ends the hiking cycle and possibly begin to cut rate, but they offer protection against inflation. So if we see an uptick in inflation as we expect it to have during the last quarter of the year, that would provide a nice buffer against this risk. We also really much like short-term U.S. Treasuries and high-quality bonds, but we don't see much value into taking long duration because duration is expensive. You get 80 basis points less when you buy 10-year U.S. Treasuries, and you can maximize the return taking much less duration risk. So in terms of risk and reward ratio, we don't believe that it's the time to add on duration at the moment.